The SpaceX IPO just set the record for the largest IPO in history. $75 billion raised in a single offering, and market commentators are upset about it. I'm John Cervantes. This is the Practitioner's Brief, and today I'm talking the SpaceX IPO and why the financial press wasn't too happy about it. Valuation is too high, the float is too thin, retirees are being used as exit liquidity, but a lot of that is theater. I'm not going to opine as to whether SpaceX is a good investment. What I want to do is give you the practitioner level framework for thinking about the IPO. And then I'm going to close out this 3-part series called What is Your Portfolio Actually Made Of? Because this IPO doesn't exist in isolation. It's part of the market's broad capital raising cycle. If you haven't watched parts 1 and 2, here's the short version. In part 1, I showed you that the S&P 500 has quietly transformed. In 1975, roughly 83% of the index's value was tied to physical assets, factories, machinery, land. Today, that number has inverted. According to Ocean Tomo's 2025 Intangible Asset Study, 92% of the S&P 500's market value is now intangible: software, brands, algorithms, intellectual property. That was the asset-light era, and it worked extraordinarily well. In part 2, I showed you that era is now under pressure. The same companies that defined the asset-light growth, Microsoft, Amazon, Alphabet, Meta, are now spending like industrial conglomerates. Morgan Stanley estimates $2.9 trillion in AI infrastructure spending between 2025 and 2028. The most profitable products in the global economy are no longer software subscriptions. They are physical memory chips. Samsung, which ranked 16th in global profitability a year ago, is now projected to be one of the most profitable public companies in the world, behind only Nvidia. So the regime is shifting, and SpaceX is the next chapter in that story. So what actually happened in the IPO? Because the noise buries it. SpaceX priced at $135 a share, raising approximately $75 billion. And it was a near textbook IPO outcome. Modest appreciation on the debut, pretty orderly trading, retail participation. By standards of major IPOs, that was about as clean as it can get. But the controversy wasn't about the IPO day, it's about everything else. The valuation, the float, the index inclusion. So we're going to take these one at a time. Complaint 1, the valuation argument. I'll give critics this maybe halfway. At $1.7 trillion, SpaceX was priced at almost 100 times trailing 25 revenue. By any traditional measure, that's not defensible, even by generous growth standards. Morningstar called the company significantly overvalued and estimated the fair value at less than half its IPO price. So by conventional metrics, yes, it's expensive. But here's where some additional perspective comes in. Elon Musk's compensation package is tied to SpaceX reaching specific market cap milestones, all the way up to $7.5 trillion. And to establish a permanent human colony on Mars with at least 1 million inhabitants. So framing the valuation through these long-term objectives helps frame why the valuation is so high. The venture capital firm Andreessen Horowitz provided some perspective on this and wrote, "The board members who signed the package spent 2 decades watching Musk make predictions about SpaceX that sounded impossible before they came true. He said SpaceX would put humans in orbit when no private company ever had. It now flies NASA's astronauts routinely. He said it would land and reuse an orbital rocket when the entire industry treated boosters as disposable. SpaceX has since done it hundreds of times. He said a satellite internet business would be worth tens of billions when satellite internet was a graveyard of bankruptcies. Starlink revenue has climbed from 0 to over 11 billion in a few years. The predictions were often aggressive on timing, but almost never wrong on direction. And the original direction written down in 2002 was the company's mission was to make humanity multiplanetary. So the board tied his pay to the mission itself. So how do you value that? You just can't. Not with the discounted cash flow model, not with the price to sales multiple. The honest answer is that SpaceX is best understood as a call option on a very wild future. So the question for any investor is not whether the story is compelling. The question is, where are you in your financial life? Are you accumulating or spending down assets? How large of a position fits within your plan? How does it behave relative to the rest of your portfolio? What does rebalancing look like if it doubles or if it drops 60%? You get none of that consideration within an index fund. Complaint 2, the float argument. Scott Galloway, one of the prominent SpaceX critics, called it manufactured scarcity. The idea being that SpaceX only sold about 4.2% of the company, keeping shares artificially scarce to engineer a pop in the stock price. But this misses the trade-off the board actually has to make. You can't just issue more shares in isolation. Every share you issue dilutes existing shareholders. It reduces control. SpaceX raised the largest amount of capital in IPO history, $75 billion. That's not a small offering. Calling it manufactured scarcity while ignoring the context is a straw man argument. And practically speaking, there are multiple lockup expirations over the next 180 days that will bring additional shares to market. So liquidity is going to come and the float will grow. And this is the weakest of the complaints. Complaint 3, forced index buying will hurt investors. The argument goes something like this. SpaceX will be forced into major indexes and index funds will have to buy it mechanically regardless of price. That forced buying creates exit liquidity for insiders and it's retirees, passive investors, and index funds who get left holding an overvalued fantasy stock. While this argument sounds compelling and there's maybe a grain of truth there, we have to understand what the actual goals are of major indexes. For example, the stated objective of the Russell 1000 is to provide an unbiased, complete view of the U.S. equity market. The NASDAQ 100 markets itself as the index designed to track the 100 most innovative large cap companies listed on the NASDAQ. So investors have largely benefited from the unbiased nature of these indices. There are no valuation checks, momentum checks, earnings this or dividends that. They are largely market cap driven. It's the same index that allowed investors to participate in NVIDIA's massive climb from a rounding error in the index to the largest company in the world. Now, the indexes have each decided to handle this differently and deliberately. The S&P 500 held its line. The committee reviewed whether the shortened 12-month waiting period for SpaceX, and they decided against it. The S&P also has a profitability requirement. SpaceX does not pass it yet. So the S&P 500, the Vanguard ETF, the Spider ETF, they're not going to see SpaceX for at least 12 months and possibly longer. The NASDAQ adjusted its rules to allow inclusion after 15 trading days. The Russell indexes moved on a fast entry basis, 5 trading days. Morningstar estimates that SpaceX could reach 1% in broad cap indices after year 1 and possibly north of 2% in NASDAQ over that same time. But the starting point for index buying will be a fraction of a percent, and there's going to be a gradual build from there. Here's what gets lost in the SpaceX debate, and this is the thread that ties this series together. While the financial press is arguing about SpaceX's float, the giants that are already inside the index have been raising capital at a pace we have not seen before. I covered this in part 2. Tech companies are estimated to spend $2.9 trillion on AI infrastructure between 2025 and 2028. That level of investment now exceeds what these companies can fund purely from their own cash flows. So they're going to the debt markets. Alphabet, Amazon, Meta, Microsoft, and Oracle have issued approximately $159 billion in new debt this year. On top of that, Alphabet raised $45 billion in additional equity. The first time they have raised equity capital since their IPO back in 2004. And they announced another $40 billion equity program to begin in the third quarter. But why does this matter to you as an investor? Because investments at this scale has to generate a return in excess of each company's cost of capital. The idea that excess returns are just going to accrue to everyone simultaneously, the model providers, the hyperscalers, the infrastructure suppliers, and the end users, is a fallacy. Someone has to capture this additional margin, and right now the market is voting on who that is. Which brings me to what I think is the most important market development of June thus far. There has been a very prominent performance spread opening up between semiconductor stocks and hyperscalers. Semiconductors are outperforming, hyperscalers are underperforming. Month to date through June 18th, the gap is significant. And it would be less notable if both groups were moving down together, but the directional difference plus the absolute spread is what matters. Why might this be happening? I think there's a few explanations. One, the market is concluding that the incremental AI investment by the hyperscalers is actually bad for their own returns, and the value is only going to accrue to the chip companies supplying the infrastructure. Two, the market is concerned about the additional equity raises following Alphabet's surprisingly kind of nonchalant capital raise. If the largest company in the index, or one of the largest companies in the index, can issue $45 billion in equity on a short notice, the market may be thinking it has to price that in for the rest of the cohort. Or three, some of the selling in the largest index holdings was simply SpaceX related. Investors rotating out of mega cap index positions to participate in the offering. All three are probably playing some role. Attributing one is guesswork, but here is what I feel strongly about. The longer this spread persists, or the more pronounced it comes, the more pressure hyperscalers will feel to respond. And we've seen this before. Meta's metaverse push in 2001 and 2022, the market didn't approve. The stock fell more than 70%, and Mark Zuckerberg had to pivot pretty hard and fast. If the market stops rewarding the AI infrastructure investment, the hyperscalers will moderate it. That is a pressure valve in the system. So why does this matter? I did 3 long-winded briefs on how the market structure has changed. Because the market cap weighted large cap indexes are set up for a world that was and is not ideal for a disruptive technology regime. Let me close with 3 questions and what I'm thinking about for the remainder of 2026. Will hyperscalers blink on capex? Alphabet, Microsoft, Meta, Amazon, even Oracle, they're all committed capital to historic levels. But they're also watching each other, and they are watching their stock prices. The prisoner's dilemma I described in part 2 keeps them spending, but it only takes one to simply moderate their spending. And you have to keep in mind, it's really about the second derivative. The growth just has to decelerate. Second, will OpenAI and Anthropic IPO in 2026? And who's going to go first? Both have filed with the SEC. SpaceX was described as the first in a series of AI-linked IPOs. OpenAI and Anthropic are widely expected to follow this fall. There's some talk of them getting pushed out to 27. But the index inclusion debate we just had with SpaceX will replay probably faster and louder, and the valuation conversations are going to be equally as challenging. Third, can falling energy prices provide enough cover for the Federal Reserve? Energy costs are a significant driver of inflation. If prices can continue to fall, can that give the Federal Reserve less pressure to raise rates? And I think that's going to be a meaningful variable for the second half of 2026. That's the close of this series. I'm John Cervantes. This is a Practitioner's Brief. We'll catch you next time.